So hello, I am David Bahnsen. I'm the managing partner of the Bahnsen Group, $5 billion private wealth management firm, and devoted economist dedicated to the cause of a free and virtuous society. And here with my friend,
David Malpass. I am a devoted growth advocate for the United States and for the world. We need to find ways that people around the world can do better, and especially in the U.S., median income needs to go up. So that's a little of what we'll be discussing. I've worked in the government a long time, Wall Street a long time. Happy to be here at the Coolidge Foundation because, for one, it's been a great discussion, but also the focus on actually solving problems is pretty intense.
well, let's talk about that solving of problems, because one thing you and I have the advantage of now is not being in any elected office. We can actually talk about ideas that might really work versus having to think about the electoral politics of it. From an idea standpoint, you mentioned a few today, I want to unpack a little. Share a little bit about this idea of connecting government spending in Washington to a debt to GDP limit.
When the Constitution was written, they didn't dream of a world where the government, their entity, would be able to borrow $34 trillion. So there's a missing element in the Constitution with regard to the size of government. Clearly they knew that it was a risk because they gave the House of Representatives the power of the purse. They said, you decide how much we can spend. But they didn't put limits on it because they didn't know they needed limits. So that's where we stand now. The government created a debt limit in 1917 during World War I for the explicit purpose of having more debt. They needed a much bigger ramp up of US government debt to pay for World War I spending. And so that is still the lay of the land in Washington, that we have this thing called the debt limit that actually is debt empowerment for Washington. So what I'm advocating is that we rewrite it and make it stronger so that it's actually a size limit on government. We don't have that now. We desperately need it. And the payoff would be huge. Imagine how wonderfully markets would respond if Washington said it wanted to constrain itself. Now, that's not what we're doing now. Clearly, to everyone who observes anything, Washington wants to grow as fast as possible. So that's the shift that would be additive to growth. The country could, I think, grow 2% faster, 3% faster, if there was the idea of size limit.
And you mentioned this on a global scale. You desire to see growth globally. We desire to see debt contained globally. What has been your experience in viewing the debt dynamics globally of other developed countries that have gone in excess of our debt to GDP? What price have they paid for it?
If we think about Japan, they're at a higher debt to GDP ratio, but what the trade-off and the cost has been very slow growth and also an aging society that's not very well taken care of in its old age. So a willingness to sacrifice as a nation in order to have the government be that big. I think Japan would have benefited from a limitation on the size of government. And as we turn to Europe, when they created the euro, they very quickly realized they needed to have some restraints on their governments. That's the government of France and Germany and Spain and the UK at that time. And so they established the Maastricht Treaty. But remember how that worked. Within 2 years, the biggest participants, Germany and France, had broken the limits that were supposed to be set in that. Those were annual limits. And so you cheated, then you broke it. I use the analogy of a diet. If you say, I want to lose 5 pounds in the first quarter of this year, a reasonable goal, then you don't do it. And then you say, well, 5 pounds in the next quarter and 5 in the next. And meanwhile, your weight is actually going up. So you need an absolute limit. And that's what I think is established by a debt to GDP ratio. So if we said 100%, debt to GDP, that marketable debt. That means don't count the debt that's held by the Social Security Trust Fund and the Medicare Trust Fund. Then you end up with a economically defensible system for the future.
Isn't it fair to point out that even 100% debt to GDP is on the high end of our historical average?
I first sought this mechanism when I worked for Senator Roth, Bill Roth of Delaware, the Roth IRA fellow, in 1990. And he actually introduced a bill in the Senate that would have, when debt was over 50% of GDP, it would have caused constraints. And of course, the Washington voted it down, and it never was implemented. It was too bad because I think economically it would have allowed faster growth and a stronger country.
Yeah. So when you think about the growth dynamics, and we've talked a bit today about the need for accelerated growth, for better productivity. We've been suffering from more muted growth since the global financial crisis in the United States. Do you think that what has held back growth is excessive debt? Is it overly accommodative monetary policy that has misallocated capital and resources? Or is it all the above?
Several factors. One of them is the regulatory state. So you have to remember businesses in the U.S. are laboring under regulations that are really hard to comply with and costly. So you see the big boom in accounting firms and compliance functions that don't help the growth. So that's one. A second one is the massive change in monetary policy that occurred in 2010 and 11. The Fed began paying interest to banks, and they began buying government bonds. And that changed the composition of the U.S. government debt unfavorably. It's important to think about it this way, that the Fed joined the Treasury Department in borrowing at the short end of the curve. That's exactly the money that small businesses need to borrow. It's floating rate finance that's needed for working capital. And so you had this giant player enter that market in 2010, and then over just a short period of years, all of a sudden it was borrowing $9 trillion from banks, and that's money that should have been lent to small businesses. So it was a shift in duration of the government debt. That decision should be left to the Treasury Department. The Fed shouldn't be changing the shape of the yield curve, the composition of the debt. And then third is just the dependence on government growth, and we know that government spending is usually poorly chosen, is often poorly chosen, and so the more you're doing of it, the slower your growth rate is going to end up being. Now, of course, there are exceptions. During an emergency, government needs to step in, and so everybody wants to focus on the exceptions, and I want to focus on the general layout is the government should not be growing the way it is.
So you brought up the fact that quantitative easing has had in loading up at bank reserves and taking away actual productive economic activity. It's not being lent out. The Fed's buying bonds. They became about 20% of our bond market, which we should point out isn't even close to the percentage Japan got to. They've been doing it for much longer, and they're over 50% of their nation's bond market.
But the growth is much slower.
And the growth is even slower.
Yep.
But I guess I wonder, do you believe that the effect of quantitative easing and a zero interest rate policy misallocated capital to where it incentivized economic actors to leverage up already incumbent assets as opposed to investing in new productive assets?
Clearly, and with a huge preference for size, meaning when you're talking about subsidizing bonds, which is in effect what the Fed was doing. We borrow from banks and buy bonds. So that's a subsidy for bonds. Who's that helping? Big government and big corporations. Yeah. And so you saw this for years and years. Apple was issuing bonds and buying its own stock back. And isn't that a symbol? Now you say, well, Apple was a great investment. That's true. But they could have done it, they could have accomplished that at slightly higher cost to them if it meant small businesses would be able to get more money.
Yeah. Well, and you bring up a great point with Apple because they're thought of as one of the great producers of a new product, although I'd point out this device we're both holding on to right now, they invented it in 2007. I mean, it's been a long time, and I would argue that the way in which they could access the bond market basically for free, buy back stock, if that hadn't been there, they could have also been returning capital to shareholders that they could have been reinvesting into other private equity, into other real estate, new inventions, technologies. It seems to me that's the underrated aspect of monetary policy, that we have disincentivized productive investment.
Yeah, that's huge. And so do we really know whether it would have been better for Apple to return to very astute investors in the form of dividends or of just stock buybacks from earnings? And then those investors would have chosen small companies that might have created something even better than Apple. So it's hard to know, but and so maybe that's not the best example. The best example is the U.S. government was the huge beneficiary from the allocation of global capital. And governments, in fact, in Europe and Japan also partook of this largesse. So the people around the world are working their tails off and giving their money to the government to invest in spending programs.
David, a lot of people that share our views about debt, about a tax base, about the regulatory state, have this general economic philosophy. Many tend to be dollar bears. You don't strike me as a perma bear when it comes to the dollar. I know that I'm not. There's concerns. I want a sound currency. I want a strong and stable dollar, and want to see policymakers defend it. But it still strikes me that we've been the best house in a bad neighborhood. What is your view in the future of the US dollar and its reserve status?
There's a tendency for financial markets to talk up or down a currency because they make money on volatility. Yeah. So they're kind of agnostic as far as the economics. So I'll state a different view. From an economics perspective, dollar weakness would be devastating to the poor, to the inflation rate. And so then can it be stopped? And the answer is it's fiat money. That means it's created by a government. And in the case of the US government, it's super powerful. So there's no reason to think that the dollar is going to be the weak link in this equation. Now, if the government chose to weaken it, then they could certainly achieve that. You know, you talk down the dollar for competitiveness purposes. But I think the best way to benefit people and to be popular politically is to have currency stability and use that so companies can invest and hire workers. And that's pretty clear from economics. So I want to shy away from those that, Wall Street has always been in favor of a wildly free-floating dollar and yen and euro that go up and down because that's how they make money. But we need to work against that and say, yeah, okay, I get that. That's fine for you to make money if I make a mistake. But if it's stable, I think it's good for everybody else.
Well, and I would argue, even from the vantage point of Wall Street, you spent a portion of your career on Wall Street. I'm a Wall Street guy. If Wall Street can't make money in the volatility of currency, they're pretty smart people. They will find something else more productive to invest in.
Not worried about their jobs.
Yeah, but what I'm saying is for the economy, I wonder if Wall Street being focused, this is what they talk about, the financialization of our economy. Wall Street being invested in the equity and debt of real businesses strikes me as a better use of their talent and capital markets than currency volatility.
Yes. And that will, but okay, that's right, except if the easiest trade, they'll always go for the easiest trade.
As they should.
And so currencies are so easy to make money when they're volatile because they get to do it faster than the average person. It's a path to impoverishment, but it makes a lot of money while they're doing it. So I think it has to be up to government to say, look, that's not the direction we're going. My plan is 50 years from now, the dollar will be an imminent currency, not the only currency, but a valuable store of savings for the world and of transaction value.
Before you talked a bit about the Fed should not be determining the yield curve of U.S. debt, the interest rate market. The duration planning of the Treasury debt really belongs under the Treasury Department. Before you went to World Bank, you were in the Treasury Department. There had been talk of extending some maturities of our debt. It seems totally off the table now as rates have gone higher. Give us a little inside baseball. Is there a possibility of 50-year, 100-year maturities of Treasury debt in the future?
I don't think it pans out from a technical standpoint. There's not a market for those right now. And the data from those that have done that, Canada issued a 50-year bond. Mm-hmm. The convexity meant that they didn't get benefit beyond 30 years. Yeah. So I think the proper question is how much longer maturity existing debt should we issue, meaning 10-year bonds and 30-year bonds. And that should have been done more heavily, both in the Trump administration, but then especially in the Biden administration. You had years and years when you could have been issuing 10-year and 30-year debt, and that would have protected taxpayers from the inflation that we're seeing.
I think we're now paying 450 basis points more for 1-year debt than we were paying for 10-year debt, and that lasted about 3 years. You had a 1 handle and a low 2 handle on long-term debt, and we didn't extend the duration of the bond, of the total debt whatsoever.
Right, so that's a $1 trillion mistake.
Yeah.
So as we start right now, I think they should be working to lengthen the maturity of the issuance, and it's one of the, they meaning the Treasury Department,
right.
And it's one of the most important decisions, given the size of the national debt, it's one of the most important decisions that they make. Think what we're talking about, it's 100%, the debt is as big as the entire GDP for a year, and you have your full range of choice. Do you want to borrow in bills, in notes, in bonds, or in inflation-adjusted bonds? And so that's one of the most profitable or unprofitable decisions that you can make. Of course, it would be good if Treasury could talk Congress and the budget and the whole U.S. government into restraining itself on spending. Yeah. That would be worth even more.
Sure.
But you got to deal with the hand that you've come with.
Yes, indeed. Well, we appreciate all of your comments today here about growth, the rate market, the dollar, global economic activity. It's been quite a conversation.
Thanks, David. Yeah, good conference at Coolidge Foundation.
Thanks so much.